If you're getting ready to retire and have a defined benefit pension, there's a big decision ahead. Should you take the monthly pension income or the lump sum commuted value? It's one of the most important retirement choices you'll make, and it's permanent. I'm Nick Hearne, financial advisor and portfolio manager at RGF Integrated Wealth Management. And in this video, I'll walk you through the pros and cons of each option and how to decide what's right for your retirement. Let's start with what these two options actually mean. The monthly pension payment is guaranteed income for life. Depending on your plan, it may be a set amount or it may be indexed to inflation. Think of it like personal CPP, steady, reliable, and no investment decisions are required. The lump sum, also called the commuted value, gives you the present value of your future pension once you retire. You transfer that amount into investment accounts where you can either manage the money yourself or work with an advisor, and the income will depend on your investment returns and is no longer guaranteed. So how do we compare receiving a lump sum today with receiving monthly payments over the course of retirement? Well, one way is through something called an internal rate of return, or IRR analysis. This calculates the investment return you need to earn on the lump sum amount to replicate the monthly payments that would occur over the course of your retirement. For example, let's say you're deciding between a lump sum benefit of $500,000 or a non-indexed monthly pension of $2,500. If you assume you'll live for 30 years, then the IRR would be approximately 4.4%. So this means you need the lump sum to earn an annual investment return of at least 4.4% to match the monthly pension option. And so if you expect to earn an investment return that's higher than the IRR, it would support the lump sum option. But if the IRR seems high or unattainable, the monthly pension may look more appealing. And while calculating the IRR is a great place to start, your pension decision is a personal one that goes far beyond just the numbers. Here are some reasons why many people stick with the monthly payments. Guaranteed income for life provides peace of mind. If it's indexed for inflation, it's a great way to protect your purchasing power throughout retirement, and there's no investment risk, as this responsibility falls on the pension provider. The monthly payments can therefore be a great choice if you value stability, are risk-averse, or don't want to worry about managing money in retirement. For others, the lump sum is more appealing. It offers the flexibility to adjust the amount you withdraw to match your spending needs. It gives you control over how the funds are invested, and it allows you to leave a legacy, as any remaining funds can be passed down to your heirs or a charity that you support. This option can work well if you have a shortened life expectancy, you want to leave assets to your heirs, or you're comfortable managing investments or working with a professional. Another factor that's often overlooked is the financial health of your pension plan. If you're in the public sector, your pension is generally backed by the government and considered very secure. But if you're in the private sector, you need to take a close look at the financial health of your pension plan. It's worth asking, is your pension plan fully funded? What's the funding ratio? Is the employer facing any financial difficulties? If the plan is underfunded or your employer is financially unstable, that guaranteed monthly income might not be as guaranteed as it seems. In cases like that, some people choose a lump sum to avoid future uncertainty. Before making a decision about your pension, you need to make sure you've thought through the tax implications. When you take a lump sum, part of it goes into a locked-in retirement account, but some may be taxable immediately, especially if your commuted value is above the CRA transfer limits. This can mean a hefty tax bill up front. It may be possible to defer the tax by making an offsetting contribution to your RSP, but you need to make sure you have enough contribution room to make this work. You should always review the numbers with an advisor knowledgeable in tax planning. Before making a decision, ask yourself, do I need guaranteed income for peace of mind? How's my health and life expectancy? Do I want flexibility in how and when I spend? Am I comfortable managing money or working with a professional? And what are the survivor benefits under the monthly option? Finally, how healthy is the pension plan itself? You can download our free retirement income planning toolkit by clicking the link in the description below. It includes checklists and guidance to help with big retirement decisions just like this. Thanks for watching. If you found this video helpful, please consider liking and subscribing for more content on Canadian retirement planning.